This is the Kryptonomics Podcast, telling you why cryptocurrencies are the kryptonite to the traditional banking and credit systems. Learn how to store, manage, and spend your wealth in the cryptoverse. Listen about Bitcoin, Ethereum, and decentralized finance, and hear from our successful crypto investors and miners about their strategies. Whatever you're interested in learning about, Kryptonomics is your one-stop shop to everything crypto. Now, here is your host, Ty.
Hello and welcome to the Kryptonomics Podcast. I am your host, Ty Amato, and you can find me on every social at SalesGuyTy. For our first episode, I sit down with one of my business partners, CJ Constantinos, and go over the very basics of Bitcoin. CJ is one of the most successful and intelligent people that I have ever come across in my entire life, and has been a personal friend and mentor to me ever since I started investing into crypto, specifically Bitcoin. So sit back, relax, and enjoy our first episode. Be sure to subscribe to us on Apple, Spotify, and YouTube, and let us know in the comments whatever questions you have after the episode. Hey, CJ, thanks for coming on today, man. I thought before we get started, we go into the nitty-gritty. We could start with just a little introduction. Tell everybody how you found out about Bitcoin and cryptocurrency and what really drew you into it and what you're doing with it today.
Yeah, absolutely. Excited to be getting into Bitcoin today. And I first started back in 2015. I learned about it from this guy named Jeff Berwick. He calls himself the Dollar Vigilante. He's still out there today, and I still recommend people go listen to his content and take in his advice and his point of view, because he has a very unique perspective on the world. He's an anarcho-capitalist, which means he's pretty much against governments, which doesn't mean you're against the rule of law, by the way, for those people out there who hear that anarchy and think it's against the law. It's not. They are for laws and respecting other people. They're just not for governments. And for many reasons, including what we see today, which is politicians overspending all of our own money, our future tax dollars, diluting our currency, devaluing the dollar and other fiat currencies, stealing our wealth to go spend on stuff that we don't need. And that's really the original understanding I had that I received from Jeff, from his specific worldview. And he didn't just bring up a problem, he also brought up a solution. He said, the solution to this problem that we're having is this new technology called Bitcoin. Everything from there, as soon as I went to college at UCF and I got my accounting degree, I already had understood a little bit about the financial system. Not as much as you would think somebody who had a college degree would understand, because they don't really teach that stuff. Most of that knowledge came later in my own studies. Having that background of a basic financial education and business education, it blew my mind. It absolutely blew my mind. And then one day Jeff uploads a video and he goes, "Hey, if you're intrigued by Bitcoin, you're really going to like this thing called Ether." And that just blew my mind when he started talking about it. So from there, the rest is history. And I've been deep in crypto ever since then.
Wow. So in 2015, you find this guy who's an anarchist, and the first thing he brings up is Bitcoin and how it can help solve a lot of the governmental issues that he saw. Fast forward to today, and he couldn't have been more right. Yeah, man. But kind of segueing into, the beginning of our conversation, I get probably 10 to 15 to 20 DMs a day of my friends, people that follow me, people I don't even know, asking me to explain Bitcoin to them. And I do my best. I got my little talking points, little bullet points that I go off of, but I figured the best way for everyone to understand would be to hear from an expert like yourself. So if you could start off just explaining what exactly the heck Bitcoin is.
Yeah, well, it's a great question. It's one of the ones I definitely get mostly asked. And from everybody, you get it from all walks of life, whether it's someone who just graduated high school or it's your grandmother and grandfather. It seems today everybody's asking, what is Bitcoin? And I think, thinking from my own experience of, how I first answered that when I first learned about it is much different than how I would answer that question now. So just to go back to the basics, I think I would say, if you say, what is Bitcoin? I would just say Bitcoin is a bank. That's all it is. I mean, we go to the bank and we put our trust in the bank to make sure that our account is going to have the right balance, that our money is going to be there when we need it. If we go to ATM because we need cash, we're going to be able to do that. And we put our trust in the bank to watch over our money. And in today's world, I think it's pretty clear that these walls of trust that have been being built for years have been violated so much. From the outside, you're looking at the wall and it looks big and it looks strong. But what you're not seeing is that all they had to do was dig a 2-foot tunnel to go under the wall. and they're going through that trust. The bankers are breaking that trust. They're in cahoots with the politicians. It's the politicians who vote and decide fiscal policy, but ultimately it's the central bank that prints that money and loans it to them. So it takes two people to play that game. And
so how is Bitcoin bridging that gap from the corrupt banking system to something that people can trust and people can use without political manipulation?
That's right. And the answer to that is that Bitcoin is really a trusted third layer accounting of entry. And that's all it is. And that blockchain technology behind Bitcoin, a lot of people, sometimes you'll hear people say, oh, it's blockchain, not Bitcoin. Stop listening to those people, because blockchain exists because of Bitcoin.
Yeah.
Any blockchain, any banker or any even business already has their own blockchain, except it's a better blockchain. It's their own accounting book with their own entries in it, and they trust themselves. The problem is how do you get an entry book where you don't need to trust yourself or somebody else? You can just trust the book. Like if you're going to write your assets and liabilities in the book, if you made a mistake, the book would tell you, hey, that's not right. You're wrong. How awesome would that be? And that's really what Bitcoin is. It's that third entry layer of accounting that can be trusted. And that trust is not centralized on like one person or company like a bank. It's centralized onto a network, a decentralized network where no one party is looking out for another party more than it's looking out for itself.
So explain decentralized.
Yeah, so decentralized is being autonomous and being spread out, whereas centralized is being even centrally located to where you can point your finger and say, that's who's in charge, or that's where this thing is, that's where this thing lives. A bank is a good example. If you want to go to JP Morgan Bank, you can just go on Google and look up where their home office is, and you can go there. You know who the CEO is. You know who the board members are. It's centralized, meaning that people know exactly who's in charge. And if something happens, if a mistake is made, they know who to point the finger at. This is your fault. On Bitcoin, in decentralized networks, there is no one to really point the finger at. There is no one entity or person that's in charge. The permission is decentralized into the community.
So in layman's terms, Bitcoin is like a bank that people can trust because there's no banker manipulating the system with whatever sort of political influence. It's a bank that lives by its own like preset rules.
Yeah, in a way, that's absolutely right. And that may not be the simplest way to say it, but I'm just trying to draw a parallel for people who are new to Bitcoin. And, a lot of people come into the market and they think, oh, it's like gold. It's like, and then Litecoin is like silver, and it's just another investment. It's just another asset. And that couldn't be more far from the truth. It's so much more than that. And the layer of trust and security that the Bitcoin network delivers is not delivered in any other financial product, business, or marketplace. It's only delivered in Bitcoin. And it comes from the way that the Bitcoin is mined. And you have a decentralized network of miners who constantly are adding entries and accountings to a book. So let's say I all of a sudden I want to have 1,000 Bitcoin. So I come up to the Bitcoin blockchain and I say, oh, here's my address. I have 1,000 Bitcoin. Well, technically that would get sent. That information would get sent to the chain. But miners who are maintaining the entries would then see that entry and say, wait a second, we don't have this entry recorded on the previous chain and the previous chain, the previous chain, each block that is added to the blockchain. That's not there. Where did those 1,000 come from? That's not authentic. We reject that reality. So that person who's trying to claim those 1,000 Bitcoin, they can't just write that into the book that they have it. Whereas in the traditional banking system, you see what they do. Oh, you need stimulus money? No problem. Let me just type that in. Okay, there's $600 for you. Okay, there's $600 for your kids. Leave us alone now. There is nothing that is protecting the dilution of the currency that's being used to exchange value between people and businesses.
So back to the comparison of a Bitcoin being like a bank. Why should someone trust Bitcoin with their money instead of the traditional way of going to a bank?
Right. So one of the sayings in cryptocurrency is be your own bank. And that's what's so great about it. Bitcoin is like a bank, but when you hold your Bitcoin, you are being your own bank. So all you have to do is trust yourself, because there's an automatic third layer of trust built into the network. So you don't have to worry about JP Morgan saying, oh, your money is here, don't worry about it. Or your money's not here and don't worry about it. Also, if you make a mistake, like if you send your money to the wrong place or wrong address, or even an invalid address, your Bitcoin's gone forever. You can't call the bank and say, hey, something happened, help me, get my money back. All you can do is look in the mirror and call yourself stupid and, double and triple check before you do these things, because with great power comes great responsibility. And I know that's a cheesy line, but in this case scenario, it's really true. You can be your own bank. You can reap all the benefits and rewards of being your own personal asset manager. But at the same time, you're taking on that added responsibility and risk.
So Bitcoin is like being your own bank. So then why does Bitcoin's price keep going up?
That comes down to what I like to call Kryptonomics, which is a play on economics, because it's just the crypto version of worldly economics. And what we see in the traditional system is the Federal Reserve and central banks around the world, even the IMF, the International Monetary Fund, or the BIS, the Bank of International Settlements, all of these bankers are controlling and manipulating the banking and credit system by manipulating interest rates and messing with the supply of currencies. And in the traditional system, what you see is that these politicians, they might collect $4.6 trillion worth of taxes, but then they turn around during that year and they spend $7 trillion worth of taxes. So what happens to make up for that $3 trillion deficit? We just print more money. And when you print more money, you create more money, you dilute the existing currency. So as you dilute the existing currency, other assets that are priced in dollars, if their supply is not growing at a faster rate than the supply of the dollar, then those asset prices are going to increase. Not necessarily because those asset prices went up in value, but more so because the dollar lost some of its purchasing power due to the dilution and creation of the new currency used to make up for the deficit. So we're stuck in this black hole of government spending and deficit that continually devalues the dollar. And as the dollar continually devalues, that forces an asset like Bitcoin, which is inflated at a much lower rate than the dollar. Matter of fact, in the year 2020, 23% of the entire US dollar supply was created in the year 2020. So when you look at your home value, or you look at the value of Bitcoin and you see that it's gone up 23% or more, well, just know that if you went up 23%, you broke even, because there were 23% more dollars created and forced into the system, diluting the purchasing power of the existing dollar. So you had to go up 23% just to maintain your purchasing power. Now, if you exceeded 23% like Bitcoin, you gained purchasing power. And where Bitcoin exceeds the value of growth against the dollar, that's based not just on the difference of its nominal value and real value, but that is based on the supply-demand economics of Bitcoin. one of the basic things they teach you in your regular gen ed econ, the micro and macroeconomics, they'll teach you the supply demand curve. And, you know, one example they'll give you is like during a hurricane, if you want to buy a case of water, it could cost up to $100 for a case of water. But if you went to the grocery store a week before the hurricane got there, you could have got that same case of water for $5. So why is that? What happens in the markets that cause that kind of discrepancy in price? Well, a week before the storm, there was a large supply of water. You could go to the store and they might have limits on it. You might only be able to buy one or two, but you're still only going to have to pay $5 for it. Well, now all of a sudden it's 3 days until the hurricane gets here and it's going from a category 3 to a category 5 and people are really starting to freak out. Now everybody's going to the store. They're limiting you to one case, and that case you can still get it for the $5 because a lot of times the governments make laws that you can't raise those the stores can't raise those prices. Yeah. And you go and you get that water and the supply dwindles down. But you know what's happening to the demand? The demand is growing.
Is that kind of what's happening right now? There's a hurricane of inflation coming because of all the money being printed. So everyone wants to get their water, aka Bitcoin, but there's not that much Bitcoin left.
That's absolutely right. There's such a limited supply of Bitcoin and there's such a high increase in demand. And what happens is when that hurricane hits you and the stores aren't open, well, that day before, you're going to find the guy on the corner selling cases of water for $100, and people are going to be paying it because they did not prepare, and the supply is low and the demand is high. And when that happens, the laws of economics tell us that the price is going to go up. Now, if you had something like, what do they call those people who go into those zones and help? The medical Red Cross. If you had Red Cross on standby and they had thousands of cases of water, and then all of a sudden they were going to increase the supply of water, then that guy standing on the corner, he would not be able to sell his case for $100 because the demand would be met by the increase in supply from Red Cross. Well, companies can dilute their shares, governments can dilute their currencies, but nothing can dilute Bitcoin. There's 21 million Bitcoin and there will never be any more Bitcoin. No matter how many people want Bitcoin, there will never be any more.
So there's a finite amount of Bitcoin. The more popular it gets, the more mainstream it gets, the more demand there is. So the higher the demand, fixed supply, sending the price up. So besides the economic supply and demand factor of it, where else is the price being derived from? I believe it has to do with proof of work, but let's explain proof of work and go into where that price comes from as well.
Pretty much any asset class is going to go through a price discovery cycle. It's just the laws of economics. Cycles are natural and they're part of economics. And you see them in real estate, you'll see them in commodities, you'll see it in everything. And you can really never get rid of them. I've studied economic cycles all the way back since the American Revolution. In 1779, there was an economic crash from an overexpansion of debts resulting from the Declaration of Independence. So these cycles, even before the Federal Reserve was in control of the U.S. Policies since 1913, there were still issues with economic cycles. And really, it's because of the human element that's involved. But we'll get into that later. What I'm trying to say here is that every asset is going to go through a cycle from being fair valued to undervalued, back to fair valued, and then to overvalued. Back to fair valued, undervalued, fair valued, overvalued, again, again, and again, and again. It's a process of price discovery that takes place naturally from the laws of economics. So when we look at Bitcoin and we see that there's a low supply and a high demand, and the price is going to the moon, like back in 2017 when Bitcoin was trading for $20,000, one of the questions you have to ask yourself is, okay, well, what is the fair value of Bitcoin? I understand what the market price is, and I understand the dynamics that are bringing about that market price. But why is Bitcoin trading for X amount of dollars over its fair value? How can we measure fair value? And that's one of the most important questions for any Bitcoin investor to ask and truly understand the floor price of Bitcoin. And when you want to calculate the floor price of Bitcoin, what you need to do is you have to ask yourself, just like any other asset class, how much does it cost to produce this asset? I mean, does that make sense?
Yeah, it kind of reminds me of real estate. Like, how much does it cost to build this house? Like the labor, the materials, everything that goes into building a house. And then the people that built it are going to, mark it up a little bit before they sell it. But you can't buy a house for less than it costs to make it.
There you go. You hit the nail on the head. That's exactly right. And guess what? You can't sell a Bitcoin for less than it costs to make either. It's not a sustainable business if you do.
So where does that cost? Like, let's break down that cost of what it costs to make a Bitcoin.
Well, there's multiple costs that are involved with Bitcoin, and those costs are not the same for every participant. Somebody in the United States is going to have a higher cost to produce Bitcoin than somebody in China or somebody in Central Asia. Electricity costs play a really big role. I know where I am, I pay 12 cents per kilowatt hour, and the best miners are paying around 2 to 3 cents per kilowatt hour. So just right off the bat, my electricity costs here where I am are 6 times higher than where they are in other places in the world. So pinpointing this cost of production is really hard to do because there is no universal, this is what it costs. It's more of like an industry average based on your demographics and even your geographic region and what kind of electricity costs that you have access to. Actually, recently I saw an article that Kentucky is looking to pass a law that says Bitcoin miners will not have to pay taxes. So now we're starting to see states trying to incentivize Bitcoin miners to come mine Bitcoin in their states, use the cheap electricity in their states to mine Bitcoin because they see where this is going. And
okay, so there's a lot of variables that goes into the actual like monetary cost, but in terms of the tangible fixed things people are going to have to pay for, one being electricity, like what else are they paying for when they're actually mining a Bitcoin?
Right. So you're paying for, number one, like you said, the electricity. Number two, you're paying for the hardware, which is a big cost. You can get your hardware mainly out of China or at least Asia, where most of the producers are.
What would hardware consist of?
Hardware would consist of a frame. It would consist of your chips, your processors, depending on what kind of unit you have. I think probably the most popular mining unit we know today is called an ASIC unit. That stands for Application Specific Integrated Circuit. These are computers that are good for nothing, and I mean literally nothing, except for mining. When they're no longer good to mine, they're only good for a doorstop.
Literally,
all they can do is hash at a very fast rate and calculate these things that need to be calculated in order to mine. And that's all they do. So to get that kind of equipment for Bitcoin, typically it costs somewhere around $2,000 per machine.
So we got electricity, we got hardware. What other things go into the cost?
Yeah, so you have the overhead costs. You have your management costs for someone to maintain the rigs. If you want to apply your own software, you have software management costs and update and firmware costs.
Okay.
You got a house that is mining rigs, so you need a location. You need electrical capacity at those locations. These miners are not something you just order from Amazon and plug in your bedroom and start mining Bitcoin. You need 240 watt or 220 volt electricity running, and you need it running in a tight setup. You also need air to come over these miners, because if you're in an area like I am, I know with my mining shed, what we do is we cut out the whole front wall of our shed and put vents there so that the miners could have a flow of air constantly coming over them. And we have an exhaust fan on the back. So every 12 seconds, every piece of air in that shed is being sucked out and new air is being brought in order to try to cool the cards and keep fresh air flowing over the cards, because they're running at a very intense rate and it generates a lot of heat.
So we have electricity, we have hardware, we have labor from management, we have potential software like firmware, and then we have ventilation and housing and shelter for the actual CPUs. That's about
right.
six costs that go into the production of Bitcoin. Is there anything else?
Well, you have to consider the cost of storing your Bitcoin. So typically the person who manages the farm would also understand how to manage the coins, but maybe you're an institutional investor and all you did was buy the rigs and hire out a team. There's additional cost of storing
in terms
Bitcoin.
of the price floor, most of the cost of production that goes into the price floor is happening from those main 6 variables that we just covered, correct?
That's right. That's right.
So then so the price floor, like what is the price floor then? Is there like a specific number? Does it like change like every month or so?
It's constantly changing because not only is it an industry average, and different geographic locations are going to afford you different pros and cons and savings and costs depending on where you choose to set up base, but there's also taking account into the algorithm. So with Bitcoin, a lot of times what you'll see people looking to buy a miner for 2,000 and they're going to get it a couple months later, but that's okay because it's going to make $300 a day. So in less than a month, they're going to pay for their miner and they're going to be in the profit. But 2 months later, by the time they get their miner, the difficulty has adjusted upwards twice. And the network has,
what do you mean by difficulty?
So within the Bitcoin mining algorithm is what is called the difficulty adjustment. And the difficulty adjustment is an algorithm that's designed to either increase or decrease the difficulty to mine Bitcoin, or in other words, the amount of computing power it takes to create and produce one Bitcoin will either increase or decrease.
So that's the difficulty rate? Rate of difficulty?
Yes, that's the difficulty rate.
And how often does that change?
It's supposed to change every 2016 blocks. And at 10-minute blocks, that's approximately every 2 weeks. But the way it works is that if blocks are being created at a faster than 10-minute rate, because the 10 minutes is what should be the average time to create a Bitcoin block. So if it's being created faster than 10 minutes, then the algorithm increases the difficulty, and it increases it at a rate at which it anticipates that block times will then increase back to that 10-minute time. But if the difficulty is too high and blocks are only being produced every 11 minutes, then when the difficulty adjustment takes place, it will be a negative difficulty adjustment, meaning it will be easier and cheaper to mine Bitcoin. And it'll make that adjustment trying to get that average block time back to 10 minutes.
So the difficulty can either increase or decrease the amount of time it takes to mine a block of Bitcoin.
That's its function. That's its measurement. The difficulty really is a direct correlation to the cost of production, because when it's harder to mine a Bitcoin, miners have to contribute more computing power, which means it costs them more. When it's easier to mine a Bitcoin, they can use less computing power, therefore it costs them less.
So depending on the difficulty adjustment, it's either going to cost people more or a little bit less to mine every single block.
Not every single block, every 2016 blocks.
Or 2016 blocks.
Adjustment will take place. And then for that next 2-week period, the difficulty will stay the same and then adjust again after that 2-week moving average.
Let's touch briefly on the halving rate, because I know that kind of goes a lot into the cost of production as well.
Yeah, so the halving is like the worst nightmare for a miner, because you know one thing's for sure. That next moment, that very next block after that 210,000th block, that very next block, you are going to receive half the amount of mining rewards that you received the day before. And that is part of what I like to call the supply shock. That is really the catalyst to what I call the price discovery cycle. And I call it a price discovery cycle because what happens is when that halving is initiated And like I said, that halving happens every 210,000 blocks, which is approximately 4 years. When that takes place, the miners' rewards are cut in half. Another way to say that is when the halving takes place, the cost of production doubles. The price floor doubles immediately. What that does is it causes the producers of the asset, and maybe today there's some people out there that are involved in construction and are aware that lumber costs are going up dramatically. The cost to buy the wood, to buy homes, and to do all this work, carpentry work, it's going up significantly because the cost of wood is going up. So does the carpenter look at the customer and say, well, the cost of wood is more for me today. Looks like you got lucky and I'm going to make less. No, absolutely not. That cost is passed on to the consumer. Like you said, when that builder is building a house, the materials are going to cost you X, and you're going to have to charge X percentage above that material cost in order to make the profit you need to stay in business. Well, when that material cost increased, you're not picking out of your own pockets, you're passing that cost on to the consumer. So the producer, the Bitcoin miner, when those costs double, he has no choice but to pass that cost on to the consumer. And when that cost is passed on to the consumer, we go into what I like to call price discovery, new all-time high price discovery, because nobody knows. We're now getting into that speculative phase, right? We have a supply shock. We know that there's a hurricane coming. There's a whole bunch of people that want Bitcoin for protection. There's not enough Bitcoin to go around. Oh, and by the way, it now costs me twice the amount of money it cost me yesterday to produce that Bitcoin. So guess what? In very short order, it's going to cost you, the consumer, twice the amount to get your hands on that Bitcoin.
So the halving helps control the supply in terms of how much is getting put into the market. How often does the halving happen?
The halving happens roughly every 4 years.
Okay. And when was the last time it happened?
May of 2020.
So almost a year ago. Is that why the price has gone up so significantly?
It's absolutely why the price has gone up.
And it's not going to happen again for another 4 years. So is this entire 4 years of this halving rate? Are we just going to see constant price increases, or is it going to level off eventually and, sit at a stable price?
It will never sit at a stable price until the issuance schedule is complete. Now, the halving is the specific protocol that's designed to control the issuance schedule. So before 2012, there were 50 Bitcoins that would be rewarded per block. So a miner would receive 50 Bitcoins if they mined a block. Then the 2012 halving took place. After that halving, 25 Bitcoins were issued per block. After the 2016 halving, 12.5 Bitcoins issued per block. After the 2020 halving, 6.25 Bitcoins issued per block.
And in 2024, per block, meaning every time they mine a block, that's how much Bitcoin they got, a miner?
That's correct. So if you mine one block today in 2021 after the May 2020 halving, you would receive 6.25 Bitcoin.
So people are only getting 6.25 Bitcoin right now per block they mine?
Yeah, I mean that's like 180 grand for one block.
Yeah, but it's just,
and there's a block.
Like a lot. It doesn't seem like a lot of Bitcoin for all the effort you put in,
Right. Well, it's not a lot of Bitcoin. But when you talk about the cost relative to where they can sell it in the market now, what we're in now is what they call rig season. This is where the coin itself, the market cost of the coin is significantly above its cost of production. So today, roughly, it costs around $20,000 to generate a Bitcoin, and they can go to the market and sell it for $36,000. So that puts the miners in a really good and healthy position. The problem is that those miners, they aren't just mining during the good times. They're also mining during the bad times. And that's where the cost of the production plays its most important role. See, right now, fundamental analysis really doesn't mean anything unless you're trying to measure how many units away you are from that fundamental value. That's pretty much the only metric it plays at this point. And very soon, technical analysis won't mean anything either, because the hurricane's coming and everybody wants their Bitcoins and the demand is overwhelming the supply. And that will continue probably for the next year. And then what happens is eventually people who are holding the supply of Bitcoin, the Bitcoin will get to a certain price and they'll look at their Bitcoins. They'll know how much it costs to produce them, or they'll know how much they bought them for. And then they'll look at the price they can get for on the market and they will say, well, yeah, it's time for me to sell this Bitcoin. You know, this Bitcoin is worth so much more than it cost me to produce it. It is now making more sense for me to just sell this Bitcoin immediately rather than to hold it, because it's so profitable. You know, if you could build a $200,000 house and then turn around and sell it for $1 million, well, you're going to have a lot more builders trying to build there rather than building a $200,000 house and selling it for $350,000. You see what I'm saying? Yeah. So when the market's hot, the supply starts to take over. Right now, the demand has control of the price. There's so much demand and so little supply available for sale that demand is driving this price. But eventually we will get to a point, and again, I still think there's probably at least a year left in this price discovery cycle before we start to get to the point where we're far enough away from that cost of production where the supply side, or the Bitcoins for sale, is going to start to overpower the demand for purchasing Bitcoins. Okay. Now,
so one last question before we wrap up, because we are running out of time here. And that question is, everything we just went through, the cost of production of Bitcoin and how that creates a price floor, how does that differ from the US dollar?
Well, that's a great question. Number one, there is no cost to producing the US dollar. Well, actually, I can't say that, because technically that's wrong, right? Everybody's heard the joke that it costs more than a penny to make a penny, right? So why the heck do they make a penny? But basically, the dollar is a representation of a liability. It's future tax money is what it is. It's a claim on debt. The Federal Reserve note is a claim on debt. It used to be a claim on gold, because it used to be a derivative of gold, right? So you used to be able to turn your dollars in for gold, and therefore dollars were representative of that gold. Well, you can't do that anymore. And once they made that paradigm shift, there's a really great website out there if people want to check it out. It's called WTFhappened1971.com. And it does a pretty good job of showing you what happened when the dollar was fully taken off the gold standard and how diluted the dollar became. So the dollar is representative of nothing right now. Sorry about that. The dollar is representative.
She got it right away.
The dollar is representative of nothing right now, except a future claim on a tax liability. So you look at the United States right now, and I'm looking at a very divided United States. I'm looking at conservatives, and I'm looking at liberals. I'm looking at people who are anti-government. I'm looking at people who don't give two shits. It's very divided in our country right now. And if you're a billionaire, or you're an asset manager like BlackRock, who has trillions of assets under management, this comes back to asking a question. Do I trust the United States? Do I trust the banks? Or am I better off and safer, and is there less risk in eliminating the human element and just trusting an algorithm, just trusting a code, just trusting a digital accounting book like Bitcoin, which cannot be manipulated by governments or central bankers because it's decentralized, right? There's no one they can go after. The U.S. Army can't go put a bullet in miners that are all over the world. I mean, sure, they can go take down mining farms, but how are they going to stop the couple of guys that are in random spots that are just mining?
There's already so much Bitcoin in circulation too. It's just, but for me,
Pandora's box has been opened, and anybody who's done research on this knows that DARPA and other U.S. agencies, they knew about Bitcoin when it first came out in 2009. They knew about it, and from 2009 to 2010, people were warning the U.S. government about it. And then in 2011 and 2012, those agencies performed tests with Bitcoin and were trying to take it down. And they've been trying to take it down. A lot of governments have been trying to take it down. A lot of agencies have been trying to take it down for 10 years now. And that's what makes Bitcoin so trustworthy and resilient, is that it has been constantly attacked for 10 years. And there's a decentralized network of developers and community that are protecting that ledger. So not only is the algorithm itself telling you whether or not that entry is right or wrong, but it's a network of other participants who not only have their own self-interest in mind, but at the same time, because they have their self-interest in mind, which is to maintain the ledger, they also protect the self-interest of others. It's a correctly incentivized system versus the centralized bankers where it's trust them because that's what we've always done.
So for me, Bitcoin versus the dollar, it comes down to the cost of production. It's just like Bitcoin's price is not only derived from the economic supply and demand factors, but it just costs a lot to produce it. And there's no cost of production involved with the US dollar. They just keep printing them and printing them to stimulate economic activity. Meanwhile, you have finite asset Bitcoin costs thousands of dollars to produce. It just seems like a way safer price floor in terms of its overall value compared to paper fiat money.
That's right. I mean, and what you're saying is what everybody won't admit. And I hear this all the time and it just grinds my gears. They say Bitcoin has no tangible value. That's the furthest thing from the truth.
Like, I can't see it. I can't see it. It can't be real.
Yeah. Dollars have no tangible value. They are literally printed out of thin air by politicians raising their hands and saying, this is what we're going to do, and there's nothing you can do about it. It's backed by nothing. Bitcoin is backed by a cost of production. It's backed by having a finite supply and a monetary policy that cannot be manipulated. So I can't stand people who say Bitcoin is not tangible, it has no tangible value. That's the furthest thing from the truth. Try plugging in your computer and mining a Bitcoin. Good luck.
Yeah,
you're not going to ever be able to do it.
Yeah. All right. Well, CJ, that's all we got right now for time. Thanks for coming on and explaining all this stuff. And we'll definitely be back on next week for another episode. And stay tuned. We'll see you guys soon.
Good. I'll see you on the moon.
See you on the moon. Yeah, with all my Bitcoin.